Okay, listen up. Right now, behind the scenes, the US government is getting ready for some pretty big changes. And we're not talking about small tweaks here. We're talking about shifts that could fundamentally reshape how millions of us build wealth. So we've got to dive into this, because what's coming isn't just dry policy, it's a massive signal for your money.
What are we talking about? The 2026 federal budget. I know. The word budget can make your eyes glaze over, but stick with me. If you have any money invested, whether it's in stocks, real estate, or even just a retirement account, you absolutely need to pay attention to this one. It's a really big deal.
You see, here's the secret that most people totally miss. They hear government budget and they just tune it out thinking it's all political noise. But for smart investors, these budgets are like a roadmap. They are signals that show you exactly where money is flowing, where the government is putting up roadblocks, and most importantly, where new opportunities are about to pop up.
All right, so let's get into the nitty-gritty. First on the docket, and maybe one of the biggest potential shifts, is the tax on capital gains.
So, you know how the system is set up right now, right? It gives investors a pretty sweet deal. Your long-term capital gains, that's just the profit you make from an asset you've held for over a year, are taxed at a much lower rate than your regular paycheck. We're talking 0 to 20% for a lot of people. That is a massive advantage when you're trying to grow your money.
So if it's such a great deal, why is this core benefit for investors suddenly on the chopping block? Well, the simple answer is there is a ton of pressure building to raise those rates, especially for higher earners. And here's why. It really boils down to this. When you look at who benefits the most from these low tax rates, a huge slice of the pie goes to the top income brackets. So policymakers are starting to look at this and frame the whole thing as an issue of fairness. And that is the real engine driving this whole conversation about changing the rules.
So what does this actually mean for you? Look, it's simple. If capital gains taxes go up, your after-tax returns are going to go down. Period. All of a sudden, it's not just about what you earn on paper, it's about what you actually get to keep. And that means being smart about your taxes. You know, tax efficiency is about to become an absolutely essential part of your investment game.
Okay, so that's capital gains. But that's not the only thing they're looking at. Let's shift gears and talk about another huge area that's getting a ton of attention right now: real estate.
I mean, for years, real estate investors in the U.S. have had some absolutely incredible tax perks. We're talking about things like depreciation, writing off mortgage interest, and of course, the big one, 1031 exchanges. That's the one that lets you sell a property and roll the profits into a new one without paying taxes right away. These have been the absolute cornerstones of building wealth through real estate.
But you guessed it, there's a growing discussion now about tightening the screws on some of these very powerful benefits. So the big question is, why? Why now?
And the answer connects to a much bigger story, one you're probably hearing about all the time: housing affordability. It's becoming a massive national issue, right? More and more Americans are being completely priced out of the market, while at the same time, investors are using these tax breaks to scale their portfolios. That tension is forcing a hard new look at the rules.
So think about it. What happens if real estate becomes less tax-friendly? Well, the money doesn't just poof, disappear. No way. It moves. It'll find a new home. It's likely going to start flowing more heavily into stocks, ETFs, bonds, you name it. Capital is like water. It always finds the path of least resistance. As one door gets a little harder to open, you can bet another one is about to swing wide open.
Okay, so we've got capital gains in real estate. Now let's zoom out and see how this all connects to the bigger picture, starting with your retirement accounts.
So your 401k, your IRA, these accounts have amazing tax advantages. That's the whole point. But now the conversation is starting to focus on what they call high balance accounts. We're talking about accounts with millions and millions of dollars in them. Now look, this isn't going to affect most people directly, not right away. But you have to see it for what it is, a giant flashing signal that the underlying philosophy is starting to change.
And here's that shift in thinking. The new argument goes something like this. Hey, retirement accounts are meant for, well, retirement. They weren't designed to be unlimited tax shelters. And that seemingly small change in perspective, trust me, it can lead to some massive policy changes down the road.
And you have to remember, all of this is happening against a really tough economic backdrop. We're all dealing with unpredictable inflation, high interest rates, and a rising cost of living that's putting a real squeeze on households. Everything is just more expensive.
And all of that, it changes everything about how you need to think about your money. This is not a passive environment anymore. The old days of set it and forget it investing, yeah, those days are over.
So with all these potential problems and changes, what should you actually do? Well, this brings us to the most important part of this whole explainer, your new investment playbook. It's time for a shift in mindset.
The old playbook was pretty simple, right? Earn more, buy assets, use the tax advantages, and just repeat. But that's just not enough anymore. The new approach is less of a straight line and more like a strategic map. It requires more awareness, more strategy, and a whole lot more flexibility.
Okay, so let's break this new approach down into 3 clear, crucial steps. Number 1, diversify. Seriously, don't put all your faith in one single asset class. Number 2, be tax aware. You need to start thinking about your tax exposure just as much as your investment returns. And number 3, be intentional. Know exactly where your money is going and why it's going there.
And if you're just starting out on your financial journey, this is actually a massive opportunity. Because while a lot of people are going to be reacting to these changes, you can be proactive. You can build your entire strategy from the ground up with this new environment baked right in.
And this is the bottom line. It's not just about knowing that these changes might be coming. It's about acting on that knowledge. Time and time again, the people who understand these kinds of shifts early, they're always the ones who benefit the most in the long run.
So remember, this isn't just another boring budget proposal. It's a signal of a fundamental shift in how wealth is built in America. The rules of the game are changing. The only question left is, are you ready to adapt